In mid-November 2024, a quiet shift began inside the global financial system. There was no announcement, no emergency meeting, no headline on the evening news. Yet within a narrow window of time, trillions of dollars began moving away from United States assets through channels few people ever watch. This was not panic. It was preparation. For decades, the dollar sat at the center of global trade because trust held the system together. That trust has been thinning for years. What changed in late 2024 is that one of the largest holders of dollars began acting on that reality. Understanding why matter times 0.3s, because this is not a forecast. It is a process already underway. On November 15th, 2024, a sequence of transactions began moving through the global financial system without public acknowledgement. There was no press release, no official confirmation, and no visible disruption on the surface. Yet, beneath that calm, an unusually large volume of United States assets started changing hands. According to capital flow data and custodial records tied to central bank activity, the scale was extraordinary. Roughly $3 trillion in United States Treasury bonds and related dollar assets were sold through indirect channels over a short period of time. To understand why this matters, the scale has to be placed in context. $3 trillion is larger than the annual economic output of several major developed economies. It exceeds the gross domestic product of the United Kingdom. It is comparable to the combined market value of some of the largest publicly traded corporations in the world. This was not a marginal portfolio adjustment. It was a structural repositioning. The transactions were not executed openly. They were distributed through intermediaries, routed via sovereign wealth funds, custodial banks, and offshore structures designed to avoid drawing attention. This is standard practice when an institution wants to reduce exposure without triggering market instabilities. Time 0.5s. Large holders do not announce exits. They disperse them. The absence of a headline does not indicate the absence of action. The entity behind this movement was not a private fund or a speculative institution. It was tied to the central banking system of the People's Republic of China. This conclusion does not rely on anonymous sources or conjecture. It is inferred from changes in Federal Reserve custody holdings, Treasury International capital reporting, and correlated movements across multiple reporting jurisdictions. Individually, each data point appears unremarkable. Together, they form a consistent pattern. For year, time 0.3s. Analysts have debated whether major foreign holders would ever meaningfully reduce their exposure to the dollar system. The assumption was that doing so would be self-destructive, that selling United States treasuries at scale would destabilize markets and harm the seller as much as the issuer. That assumption rests on the idea that exits must be abrupt and public. What happened in late 2024 followed a different logic. It was incremental, quiet, and coordinated. This was not a reaction to a single policy decision or a short-term market fluctuation. It was the continuation of a long preparation phase. China has been gradually reducing direct treasury holdings for more than a decade, while simultaneously building alternative financial infrastructure. The November transactions did not start that process. They signaled that it had reached a new stage. The significance lies less in the immediate market impact and more in what the timing implies. Large reserve holders do not move at random. They act when the perceived balance between risk and opportunity shifts. When an institution begins accelerating its exit from a system it once relied on, it suggests that its internal models no longer assume long-term stability. At that point, the question is no longer whether change is coming, but how the system absorbs it. To see why this shift carries broader consequences, it is necessary to understand the role the United States dollar has played for more than half a century. Since the early 1970s, the dollar has functioned as the primary reserve currency of the global economy. This status was not symbolic. It shaped how trade was settled, how capital moved, and how governments managed their reserves. When nations exchanged goods, energy, or raw materials, those transactions were overwhelmingly priced and cleared in dollars. This structure emerged after the United States ended the convertibility of the dollar into gold. In exchange for abandoning the gold standard, the United States constructed a new form of monetary anchor through agreements with major energy exporters, most notably Saudi Arabia. Oil would be sold in dollars, and surplus dollars would be recycled into United States financial markets. Over time, this arrangement expanded beyond energy. The dollar became the default medium for global commerce. The advantage this created was profound. Other countries were required to earn dollars by producing goods or providing services. The United States, by contrast, could issue its own currency to finance spending, absorb trade deficits, and support financial markets. As long as foreign governments and institutions trusted the dollar to retain value, demand remained strong. That trust functioned as the foundation of the system. Over the past 2 decades, that foundation has been steadily weakened. Trillions of new dollars have been created to fund wars, financial rescues, stimulus programs, and persistent fiscal deficits. At the same time, the dollar system has been used as a policy instrument. Sanctions, asset freezes, and payment restrictions have demonstrated that access to the dollar is conditional. The currency is no longer perceived as neutral. Infrastructure. It is increasingly viewed as a lever of geopolitical power. For countries operating outside the political alignment of the United States, this introduces a strategic risk. Holding reserves in a currency that can be restricted or rendered inaccessible creates vulnerability. China has observed this pattern closely. Rather than challenging the system directly, it has spent years developing alternatives alongside it. This includes bilateral trade agreements settled in local currencies, the expansion of currency swap lines, and the construction of payment mechanisms that bypass dollar-based networks. The reduction of dollar exposure, therefore, time 0.3s, is not an isolated financial decision. It reflects a reassessment of dependence. When a major economy begins treating the reserve currency as a liability rather than a safeguard, the implications extend beyond balance sheets. It signals a shift in how power, trust, and risk are being recalculated across the system. What unfolded in late 2024 fits within this longer arc. The sale of dollar assets was not intended to collapse markets or provoke immediate retaliation. It was designed to reduce exposure ahead of a future transition. The mechanics were quiet, but the logic was clear. If the system is moving toward fragmentatio, time 0.3s. Those who move first preserve optionality. Those who wait absorb the consequences. The reduction of dollar exposure does not occur in isolation. It is paired with the construction of an alternative framework designed to function when reliance on the existing system becomes a constraint. Over the past decade, China has focused on building that framework incrementally. Rather than announcing a replacement for the dollar, it has assembled the components required for one to emerge over time. One element of this strategy has been the formation of economic alliances that operate outside traditional Western financial centers. The group, commonly referred to as the BRICS nations, has expanded its scope beyond symbolic cooperation. These countries represent a significant share of global population and an increasing portion of global production. Their coordination has centered on reducing dependence on dollar-based settlement, particularly for trade in energy and commodities. This effort accelerated as additional countries signaled interest in joining or aligning with the bloc. Several of these nations play critical roles in energy production, logistics corridors, and regional trade networks. Their participation alters the incentive structure of global commerce. When large volumes of trade can be settled without touching the dollar, reserve requirements begin to change. Parallel to this diplomatic expansion has been the steady accumulation of gold. While official disclosures report relatively modest holdings, independent estimates suggest significantly larger reserves held outside transparent reporting channels. Gold occupies a unique position within monetary systems. It does not depend on trust in an issuing authority. It cannot be expanded at will. Its value is anchored by scarcity rather than policy. The strategic relevance of gold lies in its potential role as a credibility mechanism. A currency partially anchored to a tangible reserve does not need to replace the dollar outright to influence behavior. It only needs to offer an alternative perceived as more stable under certain conditions. Even limited convertibility can shift expectations, particularly during periods of financial stress. China has also invested in physical and institutional infrastructure to support this shift. The expansion of domestic gold exchanges, settlement platforms, and cross-border payment systems reduces reliance on Western clearing networks. Control over these mechanisms matters because financial transitions rarely occur through declarations. They occur when participants quietly change their habits. None of these developments guarantee a rapid displacement of the dollar. What they do indicate is preparation for a system in which the dollar is no longer singular. In such an environment, reserve currencies coexist, influence fragments, and stability becomes conditional. The sale of dollar assets in late 2024 aligns with this preparation phase. It reduces exposure before alternatives are fully operational. The significance of this pattern lies in its direction rather than its immediacy. Monetary transitions unfold unevenly. They appear slow until they are not. Once confidence shifts, adjustments that once seemed unthinkable become necessary. At that stage, the choices available to policymakers narrow. What remains is the management of consequences, rather than the preservation of the old order. If the dollar were to lose its central position in global reserves, the consequences would unfold through a series of mechanical adjustments rather than a single event. The first pressure point would be the market for United States government debt. For decades, foreign demand for Treasury bonds has allowed the United States to borrow at relatively low interest rates. That demand is not guaranteed. It exists because dollars are needed elsewhere in the system. When major reserve holders reduce purchases or begin selling, the balance shifts. To attract buyers, yields must rise. Higher yields translate directly into higher borrowing costs across the economy. Mortgages, auto loans, credit cards, and corporate financing are all priced relative to government debt. As rates increase, leverage becomes more expensive, and activity slows. The second adjustment would occur through currency flows. Large quantities of dollars are held outside the United States to facilitate trade and reserves. When those dollars are no longer required, they do not disappear. They return. This reversal increases the domestic money supply without a corresponding increase in goods or productivity. Prices respond accordingly. Inflation accelerates not because of a policy announcement, but because excess currency competes for limited output. Historically, this dynamic has appeared in multiple reserve currency transitions. The pattern is consistent. As external demand weakens, internal stability becomes harder to maintain. Purchasing power erodes, savings lose value, and planning horizons shorten. The process does not require hyperinflation to be disruptive. Even sustained moderate inflation alters behavior, incentives, and social cohesion. A third consequence involves trade. The ability to import more than is exported rests on the willingness of others to accept the currency used for payment. Time 0.5s. When that willingness declines, trade deficits become harder to finance. Imports grow more expensive. Consumption adjusts downward. Living standards recalibrate to reflect actual productive capacity rather than financial privilege. These pressures converge on fiscal policy. A government accustomed to financing deficits through low-cost borrowing faces constraints. Raising taxes, cutting expenditures, or monetizing debt each carries political and economic costs. None are neutral. As options narrow, credibility becomes fragile. Markets respond not to intentions, but to capacity. What makes this phase particularly unstable is timing. Financial systems adapt gradually until confidence breaks. Once expectations shift, responses become nonlinear. Small changes in behavior can trigger large adjustments. This is why reserve currency transitions are rarely orderly. They are shaped by feedback loops between markets, policy, and perception. The developments observed in late 2024 do not indicate immediate collapse. They indicate that the system has entered a phase where prior assumptions no longer hold. When that happens, outcomes depend less on control and more on sequencing. Those positioned early absorb fewer shock, time 0.5s. Those positioned late face adjustment under pressure. When policymakers confront a shift of this magnitude, their options are constrained by trade-offs rather than solutions. Defending a currency status requires reinforcing confidence, yet the tools available often undermine that goal. Raising interest rates can slow capital outflows, but it also suppresses economic activity, weakens asset markets, and strains public finances. The higher the existing debt burden, the narrower this path becomes. Imposing capital controls offers another lever. Restricting the movement of money can temporarily stabilize exchange rates, but it carries a reputational cost. Once investors believe their assets may be trapped, confidence erodes faster. Measures intended to protect the system can instead confirm that stress has reached an advanced stage. Negotiation with rising competitors presents its own limitations. Monetary systems are not reset through diplomacy alone. They shift when incentives change. A country that has spent years preparing alternatives does not abandon that preparation because of short-term concessions. At that point, leverage favors the actor with optionality, not the one defending the status quo. While governments debate responses, behavior at the margins often signals deeper change. Allies begin diversifying reserves quietly. Trade agreements include settlement clauses that bypass traditional currencies. Central banks increase allocations to assets outside the existing framework. None of these actions appear decisive on their own. Together, they reduce dependence. History offers parallels. The transition from the British pound to the United States dollar did not occur through a single declaration. It unfolded across decades, punctuated by crises that accelerated acceptance of a new reality. Once credibility shifted, recovery of the old order was no longer possible. The incumbent currency did not vanish, but its influence narrowed. What distinguishes the current environment is speed. Information travels instantly. Capital reallocates rapidly. Infrastructure for alternatives already exists. This compresses timelines. Adjustments that once took generations can now unfold within years. The system becomes more sensitive to shocks, and expectations recalibrate faster. The significance of the late 2024 developments lies here. They suggest that preparation has moved beyond theory. When major actors begin acting on long-held assessments, momentum builds. At that stage, policy responses shape the distribution of outcomes, not the direction. The transition becomes a question of management rather than prevention. What ultimately defines a reserve currency transition is not collapse, but reversion. Financial systems expand beyond their productive base when confidence allows it. When that confidence recedes, the system does not disappear. It contracts back toward underlying capacity. Living standards adjust. Assumptions embedded in prices, wages, and debt are revised. Data already reflects this shift in motion. The share of global reserves held in dollars has declined steadily over the past 2 decades. Trade settled outside the dollar has increased, particularly among large emerging economies. Commodity transactions, once considered immovable pillars of the existing system, have begun to diversify. These are not ideological signals. They are operational choices. None of this implies inevitability on a fixed timetable. Transitions stall, accelerate, and pause. What matters is direction. Once alternatives are credible, the reserve currency loses its singular status. From that point forward, stability depends on balance rather than dominance. The system becomes multipolar, more fragmented, and less forgiving of excess. Late 2024 did not mark an endpoint. It marked a threshold, a moment when preparation became action, when exposure was reduced not because of panic, but because optionality mattered more than allegiance. Such decisions are rarely reversed. They reflect internal assessments that the future will not resemble the past. History suggests that once a reserve currency enters this phase, restoration is unlikely. Adaptation replaces defense. Influence narrows rather than vanishes. The process is uneven, often uncomfortable, and frequently misunderstood by those living through it. Yet in retrospect, the signals appear clear. What remains is the management of consequences. Systems, built on confidence, endure only as long as belief aligns with capacity. When that alignment weakens, adjustments follow. Not all at once, not everywhere equally, but persistently. The significance of the $3 trillion movement lies less in its size than in its timing. It reflects a judgment that the balance has shifted. And when judgments of that kind begin to converge across institutions, the architecture of the system changes, quietly at first, then unmistakably.